The Fed turns the inflation machine on autopilot. This is big news. Now, the Federal Reserve has quietly changed the way the markets work for both domestic and foreign banks. That essentially puts them onto autopilot and basically guarantees that inflation is going to continue to rise and not be transitory like they've been trying to tell us. So in this video, I'm going to break down what the Federal Reserve just did that changes things, how this works, why they did this, and how this fundamentally changes the banking system and the markets, and of course, what we should be expecting and doing about this right now. So let's go. All right, we're going to talk about what the Federal Reserve is doing because it's big news. Now, if you've been watching my videos for any time, you notice that I've cut out the whole intro piece that I normally say all the time. Let me know what you think about that because I'm trying to get through these videos faster. Let me know in a comment if you recognize I'm doing that for you and what you think, or if I should go back to doing the intro and introducing myself. All right, real quickly. So let's jump into this. So this was quietly opened up. This was quiet. The Federal Reserve tried to do this very sneaky as they've been trying to sneak many things through. Of course, if you're paying attention, you've noticed a few market analysts have already picked up on this information. And of course, I've already done videos on this as well. We can go right here. If the editor wants to link the video I did on Wells Fargo, where we touched on this, is going to expand a little bit deeper. So I've already covered it a little bit. I'm not going to go super deep, but basically we have this standing repo facility. We're going to call that an SFR. And so in that Wells Fargo video that I just referenced there, we talked about the repo market and then what happened with the reverse repo market. So go watch that. But the big news here is that this is changing banking for both domestic and foreign banks. So even if you're watching this from outside the United States, it still applies to you. This is not just for American banks, this is for foreign banks as well. And basically what this is doing is backstopping the money markets. It's backstopping the markets. Of course, that's what the Fed does, right? They prevent the markets from crashing. They prevent all these companies from failing. And this is a really big deal because this, as I said, fundamentally transforms the banking industry. So let's go ahead and dig into that and look at what's happening. So real quickly, again, I'm not going to go super deep into this because I've done multiple videos on how the repo market works, how the reverse repo market works. Again, go back and watch that video. But how they work. So real quickly, we have the repo market. And that's basically where the Fed is injecting money into the banks, overnight banks. And then the reverse repo is the opposite of that. So again, I don't want to go super deep into this, but we'll just look at it real quickly. Picture's worth 1,000 words. So in a traditional repo market, the commercial bank would basically be taking a loan from the central bank. In exchange for that central loan, they would give security or they'd give collateral. That's typically government securities or treasuries. All right, so it's kind of, so they're getting a loan, but they're collateralizing the loan. And then the next day, because this happens on a daily basis, the next day, then the central bank gives back the collateral as the bank pays back the loan plus the interest. Pretty simple, right? It's kind of like a pawn shop. If you needed some quick cash, you could take your jewelry or something valuable down to a pawn shop. They'll give you money for that. And then you have a certain amount of time to go buy that thing back if you want. It's kind of like what happened here. They gave up the treasuries. When they pay the loan back plus interest, they get the collateral, they get the treasuries back. Now, if you've guessed it, the reverse repo is just kind of the opposite. So in this situation, the central bank is going to, the bank is going to give money to the central bank. The commercial bank gives money to the central bank. Instead of in the first one, they were receiving money. Here, they're giving money. It's surplus cash. They just have it laying around. They don't know what else to do with it. Surplus cash. And in exchange for giving cash to the central bank gives them collateral. Of course, then that's overnight. The next day, it just reverses that. And so now the central bank is going to pay the amount plus the interest, and then in exchange, the bank will give back the security. And so this happens on a nightly basis. We're going to dig into that just a little bit more. But now what they've done is created a standing repo. So this means that, as I said, it's this SFR, a standing repo facility, so it's permanently open. Now, this originally started to go back a little bit in September of 2019 when the repo market spiked overnight. And so basically what happens is, each night, the banks are loaning money to each other, overnight clearing, and that is kind of set in a free market. So depends on what the banks want to loan the money for. Of course, it's collateralized, so it's good, and they're using treasuries as collateral. But what happened in September of 2019 is nobody wanted to loan the money. And so the amount of the interest rate that people want to charge went up to 10% overnight. And the Federal Reserve had to step in, and they had to They had to free the markets from seizing up overnight. They had to put $75 billion in overnight. By March of 2020, it was already up to $1 trillion a day. Now, that was a temporary thing. And then as I talked about in that other video I referenced, now we are going into a reverse repo where now the banks are trying to give the money back. Both of these are temporary measures. Now, the problem with temporary measures is that they're usually a little bit too late. So the problems have already started by the time they get put into place. And so if they can take it from temporary to permanent, that means it's there right now to be used or whenever you need it. It's like an existing credit line. Now, if you needed money real bad and you had to go to the bank and apply for a credit line, by the time, if you even got approved, by the time you got approved and got the money, it'd probably be too late. And so you want to have that credit line opened, available. In business, I like to say that we want to dig our well before we're thirsty. And so that's what they're doing here. And it's preemptive, right? So they want to preemptively move before the implosion happens. And this is fundamentally changing the market. We're going to talk about that in a minute. But I guess it's good that we're seeing a shift in the Fed. In 2008, they got kind of caught behind and they're always trying to catch up. And now what we've seen from 2020 into 2021 is that they're preemptively moving before the implosion. Something big like a deflationary crisis. So everybody's waiting for the markets to crash. It's a deflationary crisis, the credit markets to seize up. And so something like that, they're preemptively moving so that if the banks are seeing this deflationary crash and they need money, it's already permanent. They can just go get it. And basically, they've opened up for $500 billion limit for U.S. institutions, which is a pretty big amount. It's a big number, and up to $60 billion limit for foreign institutions. Like I said, it doesn't matter where you're at in the world. This does affect you. Now, the repo facility, the standard repo facility, is kind of a genius move, I guess. Depends on how you're looking at it. But basically what this does is it generates treasury demand. And so, of course, the government needs to take on more debt. And how do they do that? Through treasury. Somebody has to be willing to loan them that. What we've seen is that right now, about 85% of all the treasuries are being bought by the Fed, not by other governments, institutions like that. And so it generates demand for treasuries because now those treasuries are needed as the collateral in those situations. And it basically changes it from the quantitative easing, which we've been seeing since 2008, where the central bank creates these reserves and injects them into the banks. That's quantitative easing. They use it to buy bonds, mortgage-backed securities, etc. And basically now, instead of funding them, instead of pushing that out, they're just financing it. They're creating demand from the banks to use this, and they're financing the QE. Now, they're doing this for very, very, very cheap, a number that you wouldn't want, and that's 25 basis points. Now, 25 basis points basically means this 0.25% annualized rate. And that's why when I talk about the Federal Reserve giving basically free money to their friends at the banks, the Cantillon effect we've talked about, and then they go up and buy up all the assets, like BlackRock goes up and buys all the home. And I say this almost free money, and that's because it's at about 0.25%. I think you would agree that that is almost free money. I'd sure like to have it. But the thing that's important to understand about this, now, I didn't go super deep into this. There's other people online, most notably my good friend George Gammon. He's gone super deep into how this repo works. Him and I have spent 2-3 hours together over dinner discussing this at length, multiple occasions. The question that I always find out as he explains this inner working rabbit hole mess of detail, I always ask, so what does it mean? What should I be watching? What action should I be doing? And so that's what I bring to you. Do you really care what do you really care like how this like repo works and this account goes to this account? Like, does it really matter? If you do, if you want to watch that, go watch my buddy George Gammon's videos because he does that in detail. But I'm just going to tell you what it means. So basically, this is a massive change, all right? And I hate to say it's the end of free markets because I think we would all agree that the markets aren't really free, but it's taking even more freedom out of the free markets. And so basically what happens is banks normally do these repos between themselves. They loan money back and forth to each other. They put up collateral for that. And then there's an interest rate, whatever the market will bear, right? So supply and demand, if there's more supply, more loans available than the demand of people that want to take the loans, then the rates would fall down. However, if more people want to take on loans than there is capital available, then the rates go up. Right? That's exactly what happened in September 2019 when the rates jacked up to 10%. And so the rates are typically set by the market, supply and demand, amount of that, right? However, now what's changed, again, this is fundamentally changing, is that now banks can go directly to the Federal Reserve. So instead of this free market where banks are trading between themselves and deciding what the market thinks is the right rate, everyone can just skip that and go directly to the Federal Reserve. And by doing that, the Fed now controls the interest rate. So instead of the free market setting that rate, the Fed just says it's, as we said, right, it's 25 basis points. That's what it is. And so now that rate can't move anymore. Now, why does that matter? Well, because now if they can fix the rates, they can control the market. So the problem that the Fed has, and I've done multiple videos on this where they're kind of backed into a wall, is that they can't stop They can't taper, like they said. They can't stop pumping money into the markets, mortgage-backed securities, bonds, treasuries, etc. They can't do that. Even talking about maybe doing it in 2 years from now made the market start crashing. So they can't do that. The problem is if they keep pumping this out, inflation goes high. So what are they going to do? Well, shoot, I can't stop, but I can't continue either. Well, the third most scary option is that what they could do is they could just freeze rates. They could freeze prices. That's what they could do. And it takes it from a free market economy to a command economy, a captured, controlled economy. And so that's what they're doing. They're fixing rates so they can control the markets. This way they can artificially hold the rates down, not set by the free market, set by them. And because of that, I believe we're going to expect more inflation ahead because now they've got this under control, right? They couldn't keep printing, but they couldn't stop either. Well, shoot, now if we just freeze this, let's go. Let's just go ahead and keep pumping the markets full of liquidity. And so I would say that we should expect more inflation. And basically what they're doing is they're sacrificing the dollar. They're sacrificing the dollar to inflation. So we'll continue to see the dollar lose its purchasing power. We'll continue to see inflation going up. It's basically the same thing. When purchasing power goes down, prices go up. It's one and the same thing, two sides of the same coin, as they say. This is wrong. Sorry. That's left over from a previous slide. Sorry. But really what we want to do, this is what we're watching for, is we want to watch out for our purchasing power. Like I said, as they continue to pump in more dollars, the purchasing power is going to fall. And I want you to get your head around that because that's the most important thing. And I've talked in other videos and talked about if we look at things priced in oil or look at things priced in rice, we talked about it priced in gold. You have to start thinking about things in terms of purchasing power and not just in US dollar values. And so watch out for what's happening with purchasing power. Watch out for asset prices. I would expect asset prices to continue higher. This deflationary death spiral that they're afraid of has kind of been put on hold because now we have this standing open facility to give all this money to the banks. What I would watch for is this final trigger. What I'm really going to be watching for as danger of the end game coming is another banking crisis because now the banks have the liquidity they need and they can continue going. And so I'm going to watch the banks, and when they start getting into a banking crisis, which of course they're going to, that is going to signal to me to watch out for that end game scenario that's finally going to come at some point. Now, the debate is, are we going to have inflation or are we going to have deflation? Well, we could have both. We could have stagflation, or we could have inflation first, then deflation, which is probably what I think is going to happen because, as I said, the Fed is forced to continue, and at this point, they can't stop. It's go till they blow, as I like to say, and now the fix is in. Let me know what you think. Do you see that the fix is in? Do you think this means more inflation or deflation ahead? Leave me a comment down below and let me know. Of course, as always, give me a thumbs up on this video if you like it because you know I'm working hard for you guys. And if you don't like the video for whatever reason, feel free, give me a thumbs down. That's okay. But at least leave me a comment and let me know why. As always, ask your questions so I can talk with you in the chat. And that's it. That's what I got for you today. All right, to your success. I'm out.